Greetings viewers. I, Dr. Isha Raval, Associate Professor at Vivekananda Institute of Professional Studies, Technical Campus, Delhi, welcome you to the series on security analysis and investment management. In today's session, we will be discussing about the valuation of bonds. That means the bonds per se are debt. So when we are talking about bonds, we actually are talking about not just the corporate bonds or the government bonds, we are also referring to the valuation of debentures as well. So bonds are actually the debt securities that pay a rate of interest which is based upon the face value or the face amount or the par value of the bond. That means if a company says that we are issuing a debenture or we are coming out with a bond with a 6% coupon rate, that means the coupon rate, the rate of interest which the company will be paying is 6% and the face value is, say for example, 100. So as an investor, when you decide to buy this bond, you are technically likely to get 6 rupees on rupees 100 face value of the bond. Now, the bonds actually vary, the prices keep on changing, and one of the major factor which determines the value of the bonds is the market interest rate. Because with the change in the interest rates, the valuation of the bonds varies very, very frequently. So if the government announces or if the RBI makes an announcement of a change in the interest rates in the economy, the change in the repo rate, the reverse repo rate, automatically that gets taken care of when we are valuing the bonds, because that gets reflected in the interest rates in the markets and the valuation of the bond varies. So it is important to understand that how are bonds dependent on the market interest rate and the kind of payments which you get on the bonds. So as an investor, when we talked about the coupon rate, as an investor you are getting the interest payments on the bonds, because as a bond holder or as a debenture holder, you are actually lending to the company or you are lending it to the government. So you are neither the owners, rather you are the debt, you are the ones who are giving debt, or you are giving loan to the company or you are giving a loan to the government, depending on what sort of a bond you have bought. So when you are lending money, so as an investor, you are likely to get the return on it. Now in this case, as I just discussed, that there is always a coupon rate which is mentioned on the bonds, and this coupon rate determines your return, the interest payments which you are likely to get. Majority of the times it is witnessed that bonds, the interest payments are made semi-annually. That means twice in a year. So as an investor, you get the interest payments, and bond investors, they receive the full face value when the bond matures. So every bond comes out with a maturity period. It can be 1 year, it can be 3 years, it can be 5 years. So say for example, if you buy a bond which is carrying a 6% coupon rate with a face value of rupees 100, and today you buy this bond at a price of say 95. So here in this case, as an investor, you will be getting 6 rupees in year 1, 6 in year 2, 6 in year 3, then in 4 and then 5. Plus at the time of maturity, at the end of the 5th year, as an investor, you will be getting rupees 100 back as well, because that is the maturity value. So as at the time of maturity, the investor gets back the face value of the bond. So actually you are buying the bond at a discount and then you get it redeemed it on its face value at the time of maturity. So these are the two kinds of returns which you get as an investor. There are different varieties of bonds which are available. Like we have government bonds, then we have corporate bonds. So the bonds which are issued by the government of India, they are government bond. And when we talk about the corporate bonds, they are the bonds which are issued by the companies. Many a times it happens that the organizations, when they want quick money or they want money from different sources. Now in that case, the first option as a corporate you have is that you go to a bank and take a loan. But many a times it happens that the companies prefer issuing bonds. First they get the rating done, the credit rating of their bonds done, and then they come out with that bond and then they issue it in the market. So they get quick funds and at nominal rates from the market. So when a company issues such bonds, they are known as corporate bonds. But it is very difficult for the companies to get these bonds sold till the time they do not have a good corporate standing, they do not have good credit worthiness. So that is why it is mandatory for the companies to get their bonds rated first by a credit rating agency, and only then they can issue them in the market. And as an investor as well, it is always advisable that we invest in the bonds of those companies which have good credit rating. There are different credit rating agencies and they do the rating of these bonds. Government bonds are relatively safe because we know that no matter what, the government is going to repay the debt. So if we look from the perspective of the issuer, there are two types. One is government bond and the second is corporate bonds. The another type of bonds are callable and non-callable bonds. So callable bonds are those bonds which can be called back before the maturity. Say for example, if a company issues a bond with a maturity period of 5 years, because they know that the company feels that they will be requiring these many funds for the next 5 years because they are investing in a project which has a long gestation period. But the company decides to issue callable bonds. That means the bonds which can be redeemed even before the maturity period. Now in this case, if the bond says that they are callable bonds and they have a maturity period of 5 years, the company feels that okay, within 3 years they are able to get the required rate of return and within 3 years they are able to complete the project. In that case, the company can call back these bonds, and the investors, the people who have invested in these bonds or they have purchased these bonds, will be required to return these bonds back to the company after say 3 years if the company wishes to. So in that case they become callable bonds, the bonds which can be called back, the bonds which can be redeemed even before the said maturity period, they are called as callable bonds. Whereas the non-callable bonds are those bonds which cannot be redeemed before the desired or before the stated maturity period. So if it is 5 years for them, it remains 5 years and the company really cannot call them back. That is callable and non-callable. Another type of bond is convertible bond and then non-convertible bond. Convertible bonds, as the name suggests, they are the ones which can be converted into equity either fully or partially. That is decided by the company or the government. So the company may say that we are issuing these convertible bonds and we have the right to convert them into equity shares. Now this conversion can be full, that means the entire value gets converted into equity. So the bondholders now become the equity shareholders and they become the owners of the company. The second option is the company may say that okay, 50% we want to convert and 50% remain as bonds. So in that case, suppose you have bought the bonds worth rupees 1 lakh. So 50,000 you get equity shares and the remaining 50,000 are retained as bonds or they remain the debt. So at the time of maturity period, only 50,000 are given to you. Certainly the investors are asked whether they want to exercise this option or not. So till now we have discussed government bonds and corporate bonds from the perspective of the issuer. Then callable bonds and non-callable bonds, that means the bonds which can be redeemed early or not. So if they can be redeemed early, they become callable. If they cannot be redeemed early, they become non-callable. The third is convertible and non-convertible. Convertible bonds can be converted into equity either fully or partially, and non-convertible are the ones which cannot be converted into equity and they remain as complete debt. Another type of bond are zero coupon bonds, or the other name for such zero coupon bonds are deep discount bonds or no discount bonds. That means the word itself is saying no discount, or rather we can say deep discount or no interest, zero coupon. It means you are not going to get any interest on the bond or on the debenture. So as an investor, certainly the expectation is that whenever we are investing in the bonds, we are likely to get the interest payment because that is your return, that is the yield which you are going to get. But why would an investor invest in such a company which is offering a bond, which is offering a debenture without bearing the interest rate? But there are many companies which do that because when they are issuing these bonds, they issue these bonds with deep discount. That means a huge amount of difference will be there in their face value and the issuing price. So such bonds are the bonds where no periodic payments, no interest reinvestment rate is there, and they are originally issued at a deep discount. The return which you receive from a zero coupon bond or a pure discount bond, it is expressed on an annualized basis in the form of a spot interest rate. The spot interest is the discount rate that makes the present value of the single cash inflow to the investor equal to the cost of the bond. So what you are receiving as the single cash inflow, you convert that into the present value and then you put it equal to the cost of the bond. So these bonds are really very common in fact, and a lot of people prefer buying these types of bonds because they are available at a huge discount. Now, as you can see on the screen, the price of the bond, the calculation of spot interest rate we can do as P0 is equal to CFT, that is cash flow. CF is represented as cash flow in the tth year divided by 1 plus k raised to the power t. Now, t here is your duration, the time frame. So, cash flow, as I just discussed, when we are talking about the present value, say for example, there is a bond with a face value of rupees 1000 and it is available at 797.19 in the market or at the time when the company is issuing, and the maturity period is 2 years. So, when we really want to calculate in this scenario that how much as an investor will I be getting, what is my spot interest rate, I can do the same calculation using this formula which is given here, that P0 is equal to CFT divided by 1 plus k raised to the power t. Now, because this bond is available at a price of 797, so I mentioned 797.19 is equal to the face value, that is 1000 divided by 1 plus k raised to the power 2. So, in this case, the value of k or return or the interest rate comes out to be 12%. Now, the bond returns, that one was the difference between the issuing price and the face value. But there are different types of returns, like as I just mentioned, that the first return which you get is known as your coupon rate, which is the nominal rate of interest which is fixed and it is also printed on the bond certificate. So, whenever you are buying a bond or you are buying a debenture, the coupon rate is fixed, it is mentioned on it, and that is the rate which is fixed, and you are going to certainly get that amount every year, or whether it is semi-annually, so you will get it in a semi-annually. The second type of return is known as current yield, that is what is the profit which you are getting as on date. So, suppose you are not the first person to buy this bond and you are buying it from the market right now. So, the annual interest which you get on this bond divided by the current market price, that is P0, and when you multiply it with 100, you get your current yield. Currently, what is your profit? What is the rate of interest? What is the benefit which you are getting? So, that calculation is done as annual interest divided by P0 into 100. Now, we need to understand that whenever the bond is selling at a discount, because usually it happens that the bonds are selling at a discount, if it is available, say the face value is 100 and currently the bond is available at rupees 90. So, in such a scenario, your current yield will certainly be greater than the coupon rate. However, if the bond is selling at a premium, that means face value is 100 but it is available at say 110. So, your current yield will always be less than the coupon rate which is mentioned on the bond. Now, very interestingly, when we talk about bonds, we are certainly not buying them all the time at the time of issuing. So, maybe the wholesale debt market and the bond market is very dynamic, and we keep seeing that the prices keep on moving up and down dependent on the market structure, depending on the market scenario, the interest rates. So, as an investor, if we are buying a bond today and we hold it till the time of it matures, till the time of its maturity, we need to understand that okay, we are buying it at a different price than that it was issued, Obviously, at the time of maturity, we will be getting the face value, and we will also get the interest. Every year, we will be getting the interest till the time the bond gets matured. So, how do we do the calculation of our return? Because when you're buying it at the time of issuance, you must have done the calculation. But if you're buying it today and you are holding this bond till the time it gets matured, the yield, the profit, the return which you get is known as yield to maturity. So yield to maturity is the compounded rate of return an investor is expected to receive from a bond which is purchased at the current market price and it is held till the maturity. You are buying today at the price which is currently available in the market, and the bond is held till the time it gets matured. It is actually the internal rate of return earned from holding till maturity. So, very interesting concept in time value of money is the internal rate of return, that is the return which you are getting on this particular bond. So, you can see at the screen that the formula says we can use the terminal value method to calculate our yield to maturity, where our market price is equal to sigma CT divided by 1 plus YTM raised to the power T. So, CT is your coupon rate, the cash inflow which you are getting, divided by 1 plus YTM. So, YTM is the yield to maturity which we are trying to find out. T is the number of years for the time it is left for maturity, plus the terminal value, that is the face value of the bond, divided by 1 plus YTM raised to the power T again. Now, suppose let us understand this with the help of an example. If the face value of a bond is say 1000, so this becomes our terminal value which we are going to get. The second is the coupon rate is say 15%. The market price currently is 900 and N is say 5. So, when we do the calculation and put these values in the figure, we try to because here we have to use the trial and error method, because we already know that what is our coupon rate, we already know what is the face value, we have the value of N, we also know that what is the current market price for which it is available. We need to do the calculations that what is the yield to maturity, how much am I going to get. So, we start solving this with the help of 20%. And we look for the same in our present value tables, and we put the values here. So, 150 multiplied by PVFA, 20% and 5, and then again we find out the present value factor using the present value factor tables. We find out that if we do this calculation, if we use 20% as our YTM, the value comes out to be 850.49. Whereas, if because we know that it is not 850, rather we need 900 as the value. So, in this case, we will try to lower down the YTM from 20% and now we try it with 18%. So, when we try it with 18% and we use the same formula, here we get at 18%, the value comes out to be 906.18. So, technically, if we look at at 20% it is 850.49. and at 18% it is 906.18. So, as an investor you can easily understand that the value actually YTM will be somewhere between 18 and 20%. So, here we use the formula of interpolation and we calculate the YTM as what is the lower percentage. So, the lower percentage is 18% plus value at the lower percentage minus the desired value. So, the value at the lower percentage is 906.18 minus 900, that is our desired value, divided by value at the lower percentage, that is again 906 minus value at higher percentage. So, the value at higher percentage is 850.49. So, when we put these values here, plus we multiply it with the difference between the two percentages. So, the two percentages which we have used here for our doing the calculations, we used 20 and then we used 18. So, 20 minus 18, and when we put in all the values here, we get 18.22% as our yield to maturity. So, this one method is really very technical, but yeah, it is the correct method of calculating the YTM, that is your yield to maturity, when you are buying a bond at the current market price and you want to estimate how much profit, what is the current yield or what is your value which you are getting, what is the return which you will be getting if you hold that bond for the next, say, 3 years, 4 years or 5 years, whatever is the time left for the maturity of the bond. So this method is very popularly used by all the investors to calculate their yield, and current yield is actually different from YTM. Because in current yield, you are just taking into consideration the current interest rate and then you divide it with the current market price. However, to understand the long run return which an investor gets, in that case, we use the concept of yield to maturity. So, yield to maturity is actually the internal rate of return which you are getting from the bond. So, till now we have discussed the different types of bonds. We have also done a discussion on the return, the types of returns, like we discussed about current yield, and we have also discussed about yield to maturity. Now, with this understanding, we have kind of understood that bonds, they are actually debt. They are not a very safe investment, because when we are investing in a corporate bond, so corporate bonds are again, there are a lot of risks which are associated, whether it is a corporate bond or a government bond. But specifically the bonds or the debentures which are issued by the companies, they have an additional risk which is known as the default risk. So default risk is that the company is likely to default in terms of the payment. Now, there are two types of payments which are made. The first payment is the interest payment. As an investor, the first expectation for you is that obviously when you are lending to the company, you expect that they should make the annual or semi-annual interest payments to you. And the second insecurity which you may have is that whether the company will be able to repay the loan which you have lent. That means the face value of the bonds which you have at which you bought, whether the company will be able to repay that amount back to you or not. So if the company makes a default in terms of making these payments, whether it is of the interest or of the face value of the bond, you are likely to experience the default risk. We've seen in a number of cases where the investors, they take loans, and when they take loans, they are unable to repay. So the borrowers, they are unable to repay the loans. Similarly, the companies, if they are unable to repay either the debt or they are unable to pay the interest payments, they are not able to do all of this, then the investors experience default risk, that is the no payment risk. The second type of risk which is associated with bonds is the interest rate risk. As I discussed, that as and when the interest rates fluctuate in the market, suppose there is a rise in the interest rate and you hold a bond of say 6% per annum with a coupon rate of 6% per annum. So 6% per annum is the coupon rate. The face value is say 100 rupees. As an investor, you are going to get 6 rupees on this 100 every year. Now you will be really happy till the time the interest rate in the market is less than 6%. So if the interest rate in the market is say 4%, or the FDs which people are creating, the interest rate is 4%, 5%, you will be really happy. But the moment, and your bond will be traded at a higher price, the market value of the bond will be high when the coupon rate is higher than the interest rates in the market. But the moment there is, suppose RBI announces that the interest rates are likely to rise, or the inflation rate is rising, or the interest rate is rising, in that case, if the interest rate goes up from say 4% to 7%, or maybe even if it is 6%, till the time it is 6%, you are perfectly okay. But the moment the interest rate rises above 6% and say touches 7% or maybe 8%, now on the bond which you are getting is 6%. In the market, the interest rate is 8%. So technically, you are getting 6 rupees on a face value of 100. But in the market, if you put the same funds, you are likely to get, if you lend this 100 to a bank or you put this as an FD, you get 7% or 8%. Obviously, the worth of your bond goes down. That is why you will never ever prefer investing in a bond where in an economy, the fluctuations are pretty high, where the interest rate risk is very high, because that is one risk which is going to devalue your bond, which is going to reduce the market value of the bond. So as an investor, when you invest in bonds, you experience two risks. The first risk is your default risk. In default risk, no repayment of the face value and no payment of the interest. The second one is your interest rate risk, and the bond prices are highly sensitive to the market interest rate, as I just discussed. So if interest rate rises, the market value of the bonds, they fall in order to compete with the newly issued bonds with higher coupon rates. Why so? Because obviously if you've invested in a bond say 2 years ago, and at that time the coupon rate was 6%, but today, because the market price, the interest rates in the market are rising, new companies are coming out with bonds with higher coupon rates. So yours was 6%, but now say company B comes out with a bond with a coupon rate of 8%, because they understand that the interest rates in the market are rising. So from that perspective, when you evaluate the worth which you are getting, the value of your bond will go down, because a lot of investors will try to sell the bond which you are holding. Rather, they will prefer investing in the newly issued bonds, because these newly issued bonds, the coupon rates will be in line with the interest rates in the market. However, if it is vice versa, if the interest rates are falling, so in that case the value of your bond will increase, because the new companies which will be coming out with the coupon rates will again be in line with the market interest rate. So sensitivity to the interest rate, it actually, whenever the interest rate changes, this sensitivity becomes really severe for longer term bonds, because in the longer run we understand that looking at the market dynamics, looking at the market conditions, always the interest rates keep on fluctuating. So if you are holding a bond with a maturity period of 5 years or maybe 6 years, then the severity which you are going to experience due to fluctuations in the interest rates would be more. So it is always better you invest in shorter duration bonds, because in that case the change in the interest rates is not that frequent. And plus, the percentage rise in price is not symmetric with percentage decline, because whenever there is an interest rate fall in the market, in that case the price of your bond will not rise. The market value of the bond will not rise as compared to the fall it will experience when the interest rates rise, because we just understood that there is an inverse relationship between the price of the bond and the current market interest rate. So if you look at a case study, we can really understand that whenever the price is say constant, but the interest rates in the market are rising, your coupon rate is fixed but the interest rates are rising. So the fall which you are going to experience in your bonds, the market value of your bonds will be really deep. It is going to be it is going to be on the higher side. Whereas if it is the contradictory situation wherein the market interest rates are going down, the rise, technically your bond value, your price should increase, but in this scenario the increase would not be as much as the fall would have been had the interest rates would be falling. So that is the whole concept, and that is why we do not have many takers for corporate bonds these days. And most of the companies, they prefer either borrowing from the market or they prefer borrowing from the banks instead of coming out with bonds, because bonds per se, being a debt instrument, they are considered to be really risky, as well as they are exposed to two very crucial types of risk. The first one is your default risk and the second one is the interest rate risk. And the timings, the fluctuations in the markets, if we look at the symmetry, if we look at the variation which happens, is again dependent highly on the interest rates. That is why as an investor, when you invest, you look at the coupon rate, you make a comparison, you look at the credit worthiness of the company when it is issuing the bonds, and you also see the long-term survival of the company, the redemption rate or the duration of the bond. All of these factors are taken into consideration when we try to invest in bonds. Thank you so much. Happy learning.